Well, good afternoon, everybody. Thank you so much for joining us today for this really fascinating conversation we're about to have. We're calling it the Retirement Revolution, ETF Solutions for a Modern Retirement Planning Strategy. This is the thing. I've been doing this, as you know, for 35 some odd years, and was really early in the adoption to ETFs that when they first emerged way back in the early 2000s. Uh, it's been a while, quite frankly, since we've seen truly something new and different in the marketplace. You have an expansion of investment opportunity, but not necessarily something truly different or innovative. And yet the marketplace has changed dramatically because of longevity. We're living longer than ever before. Because of complexity in our lives, we tend to have dynamics, not just in our own marriages, but those in our children's marriages, business creation. People tend to sell homes and buy new ones with greater frequency than in the past. There are just a lot of dynamic changes, not least of which would include, for example, the changing interest rate environment. Whereas we've spent a 30-year period of interest rates doing nothing but going down, we've recently gone through a period of interest rates rising dramatically and then falling dramatically. And so this is creating the need for us to be thinking differently about our future retirements and how we're going to handle this from an economic and personal financial planning perspective. And so to help us engage in this conversation and understand the situation and look at a really couple of interesting ways to resolve this dilemma, I'm happy to be joined by Andrew Nelson, who is the Director of Product Strategy at Innovator ETFs. Andrew, great to have you with us. You're on mute, by the way. There you go.
Thank you, Rick. Happy to be here. Excited to be here today.
Andrew has been in the ETF space for over a decade. He has been at Invesco, one of the largest ETF and asset management firms in the world, and very deep in this space. And so a perfect individual to be talking about all this with us. But Andrew, I don't think most folks are terribly familiar with Innovator ETF. So tell us to start out with about the company.
Yeah, happy to. And again, as I said, thank you, Rick, and good afternoon, everybody. So as Rick flips the slide here, you'll see Innovator ETFs. We view ourselves at the forefront of innovation. So the firm was actually founded in 2017, although we view ourselves as the creator and that pioneer of a defined outcome ETF. We'll get to what that actually is in a minute. In 2018, we launched our first defined outcome ETF. And today we are actually the industry leader in this space with the most product offerings. Currently, that number should be north of 130. Now, this slide, of course, is a quarterly slide, but you can appreciate we've had a few launches since 9/30. Again, we're a very busy firm, about 130 defined outcome offerings across 6 underlying exposures. I don't need to read the entire slide to you, but I will just say that the space as a whole is ballooning. Innovator now is north of $22 billion in assets under management. For those that know the ETF industry, you know how difficult it is today to start a firm, especially again in recent history. So founded in 2017, the first launch in 2018, and really the industry leader in this idea of defined outcome. You'll see there the bottom line showing a lot of our first to market across different categories that we've developed.
It is really worth highlighting that $22 billion number. I mean, most folks don't understand the business of the ETF industry. When an ETF comes to market, the ETF provider is kind of happy if they can raise $50 million for a new ETF, because at 50 million in assets based on their asset fee, they can kind of operate the fund sustainably. And most funds struggle to do that, quite frankly. And part of the issue is getting adoption, getting brokerage firms, investment advisory firms, and advisors themselves, let alone retail investors, to want to invest in these funds. So the fact that in less than a decade, you've amassed $22 billion in assets, that really does say something about reaction by the marketplace and their interest level in what it is that y'all are doing, Andrew. So that's I just wanted to mention that because that's pretty noteworthy. But you did say that we need to talk about this, and I want to begin with that really very first question. And by the way, speaking of questions, you'll have the opportunity to weigh in with yours. Many of you already have. You've when you registered for this webinar, you submitted your questions, and we will pepper them in the conversation with Andrew. I'll be sure to toss in a whole bunch of your questions to him. If you have questions as we're having this conversation, go to the Q&A box here at the bottom of Zoom. type in your question. I'll be curating that as we go and fielding those to Andrew. So if something comes up that piques your interest or curiosity, just feel free to type that in. So you use the phrase, when you went through the history of the firm's offerings, you referred to the fact that you were the first to launch a buffer ETF. What the
Yeah.
hell is a buffer ETF?
It's a great
Let's
question, Rick.
start that. Let's
I'm
start there.
excited to answer it. So maybe a little backstory too is helpful. I neglected to mention our founders of Innovator ETFs are Bruce Bond and John Southard, the former founders of PowerShares ETFs, thus sold to Invesco. You can see the full circle nature, but what happened here is in their retirement stage of life, as they began to kind of look at what to do with their own portfolios, John Southard, our founder, was actually offered an annuity that had a structured payoff profile and thought, well, I could maybe get that in a better wrapper. Can we do that inside of an ETF? Could I innovate in that way and bring this idea into the ETF ecosystem and really bring the benefits of the ETF wrapper to bear on things like a legacy annuity product or a structured investment? So what is a buffer ETF or a defined outcome ETF? It's really made up of three components. It's an ETF made up of a reference asset. So think about SPY, QQQ. What are we trying to track? Then you tack on a buffer level. So what are you trying to protect? And I'll describe what that means. It could be anywhere from 9% protection to 100% protection over a certain last leg of the stool outcome period. Do you want to do that over 3 months time frame, 6 months time frame, 1 year, 2 year? Now the ETFs exist in perpetuity, but the strategies reset under the hood. So to take a classic example of our lineup, you might say, hey, I want an ETF tracking SPY, the S&P 500 ETF, with 15% protection over a 1 year outcome period. And so what that means is if the market falls 9% during that 1 year period, you're down zero. The market falls 12%, you're down zero. The buffer absorbs the first amount of losses to its buffer level. Now, if the market is down 20 in our example of a 15% buffer, you'd be down the net 5. And so folks have found these to be extremely beneficial. They're honestly quite revolutionary in the ETF wrapper to be this risk managed instrument that's designed to provide you a targeted level of downside protection with an upside participation to a cap. And that's the last element of this equation, is that all of these defined outcome investment offerings, in order to offer that protection to you on the downside, do have a capped upside. We think that trade-off is worth it. That's the idea of, again, and we'll get to this for our conversation, Rick, about retirement. We're more concerned about retaining assets, protecting assets, than we are about hitting home runs. We're not against being in the market unhedged, but that's part of the equation in our ETF offerings.
So talk about what that ceiling is. So you mentioned that if you go with the example ETF you gave, that you're not going to lose any money if the S&P falls less than 15%.
Yep.
But let's say the S&P rises 15%. How much of that 15% gain are you going to see in the fund?
It's a great question. So again, I'm harping on our 15% buffer suite because that's our largest and our longest data. But again, we have all different offerings and flavors. Historically, the 15% buffer idea captures about 75% of all market returns, both up and down the distribution. So most of the time, you're actually not going to get capped out, as we call it. However, that cap level will change dynamically upon market environments. The buffer, the protection, does not change. You will have that 15% protection each time the ETF resets. That cap, though, is set by market environments and what the protection cost us. Again, we are selling away our upside in order to buy that downside. And so as you think about it, we've had our 15% buffer series offer a cap of 11%, offer a cap of 16%, 17%. The cap will vary year over year based upon the market environment when the buffer resets.
And
the buffer is solid.
Once you buy the shares, once you invest in the fund, you're locked in those. Is that correct?
No, actually, that's the benefit of the ETF wrapper. That's the beauty of the ETF, is that you have the flexibility to buy and sell at any point. These are normal ETFs. They're not complex products. They're not a locked up product. It is a buy and sell whenever you want. Now, if you'd like the entire outcome period experience, you would then want to be in the ETF on day one and hold till day 365, but you're not required to. So again, most folks, it's not an issue. They're going to hold this for the entirety. They view it as a long-term holding. They're looking for that kind of the annual outcome period most times. But in reality, if they have a need for cash arise, or if they have a need for liquidity, they are able to sell that ETF intra-period. There's no, again, special features here. You can absolutely buy or sell whenever you like. Again, our website, Rick, will show you the exact parameters upon your entry and exit. But for the full designed outcome period, you need to be in on day one and holding, but you got the flexibility if you'd like to, again, withdraw early.
And if you do withdraw early, it's based on current market prices, like anything else. So leave it at that.
Absolutely.
So let me ask you this: when you do invest, it's very rare that someone's going to invest on day one. They have a 1 in 365 chance of that. So they're going to invest on a given day, and the day they do invest, they're going to know, true or false. And you elaborate on this. They're going to know what their downside
Yep.
is, worst case, and are they also going to know what their best upside case is?
They are. And so our website has a wealth of tools. If I could screen share, I would, but it's just to suffice to say, if you go to our website, every product page will have a current snapshot of every second of the day. Actually, we update this currently, and you'll see if I bought today, what's my personal buffer level based upon the market environment, and what's my remaining upside. And so again, it's all transparent. Now, I will say, Rick, to your point, to avoid the problem of having folks have 1 in 365-day shot of getting into our products, these ETFs, we have a wealth of tickers because there's ETFs resetting each month. And so the sense is you actually have a 1 in 30 chance, if not more frequent, depending upon the series you're in, because there's a new ticker resetting that you can again get into or get out of as you need. So we've kind of blanketed the waterfront with the goal in mind to make it easier for investors to enter and exit these
And
as
do
they
you
desire.
find that's what most people do? They on the first of the month is when generally most of the inflows
Yep.
come in.
Yeah, and you'll see as we mature in an industry for defined outcome or for buffers, it has been fascinating to watch the flows change. But still today, you do see a heavy amount of inflows on the first of each month. You could just kind of track our volume, and you'd see it, Rick. That a lot of times you'll see that first of the month really spike in asset flows. Now we'll get to this later, I think, but the products are evolving and people are using them intra-period, which is amazing, and how we hopefully see that going forward. But for the most part, yes, there's a lot of activity around the first of each month.
Now, I don't want to harp on the 15% buffer that you mentioned because you have an array. People can have a bigger buffer to protect them for even worse downturns, or less of a buffer if they're not so pessimistic that it might occur. But just to mention the one you did, uh, the product that offers a 15% downside protection, you said generally will offer you upside caps of, you said maybe 16%, maybe 11%. What I
Yep.
find fascinating about those two numbers you cited is that historically, as you know, for the past 100 years, the S&P 500 on average has earned 10% a year. This year, it's been a really good year. The S&P is up 22% this year. But that's an unusual year. So if the S&P is generally growing at 10% a year and you're putting a cap in the neighborhood of 10 or 12 or 14, it doesn't sound to me like for the most part people are really giving much up in order to get that downside protection.
Rick, you're taking my presentation from me. So yeah, you're speaking my language. We would agree with you. And there is an idea, though, there is no free lunch. The market is not going to give away free returns. And so where it matters is things like volatility and interest rate are going to determine the caps without getting too far into the weeds. But yeah, we see the same thing. And that's why that stat I mentioned from the beginning, if you go back to that 1950 standpoint, even that 15% buffer range with the upside being different times would still usually encapsulate about 75% of all market returns. So there will be outliers. But again, the idea
Yeah.
is you're trimming off the tails and you're giving yourself a steadier, more known outcome in your investing thesis.
So it would seem to me just intuitively based on my experience dealing with investors for the last several decades that and I think what I'm about to say is wrong, which is why I'm asking you this. Uh, that this product, I would think, would appeal to an older, more pre-retiree or retired client rather than someone in their 20s or 30s. And the only reason I say that is that the person in their 20s or 30s can be a little more cavalier about risk because they have 50 years to go. They can sit and wait it out. The markets will recover. Whereas a 70-year-old may say, I'm in retirement. I'm really concerned about protecting my principal. I want to participate in the markets, but I don't want to experience a 30% drop like we did during the pandemic. And therefore, this product, your series of ETFs might be more of an appeal to that. Is that what you're experiencing, that older investors are more interested in this than younger?
Yeah, and you were intuitively correct. Actually, we do see that, and that it's not to say the younger crowd has not utilized our product base. I liken it to this: say is that we at Innovator still believe in the adage that it is about time in the market, not timing the market. And yet at that retirement stage, you do have to do a little bit of timing. You cannot afford to have these deep drawdowns. And Rick, I passed you a slide, if you could throw it up real quick here, where
Yeah.
we look at the negative returns of the S&P. And I'll take a minute to orient to the slide, but it looks at the returns of the S&P when it's been negative, and we look at again by how negative. It's about managing risk, right? And so when you look at this from a retiree or pure retiree lens, there's an urgency around the fact that you cannot afford to have deep drawdowns. As we know, if you have a drawdown of, call it 40%, it takes almost 80 to get back. There's the element of math involved here where you have a large hole to dig out if you cannot afford to do that. And so the shorter time frames not only have produced deeper negative returns, they've also occurred more frequently. And so if you look here on the left-hand side, it takes a minute to orient to the chart. The x-axis is number of months. The y-axis is the S&P's negative returns. You'll see that the deepest negative returns, call it that 50% range, happen in a less than 12-month span of time. When you give yourself, call it 60 months, 5 years, the average rolling negative return is only about 10% in the S&P. But do your retirees have 5 years to wait? That's the question. Do you have that 5 year? And are you able to stomach even a 10% loss over 5 years on a rolling basis? That's a hard question to answer for a lot of clients. And similarly, on the right-hand side of that, the number of negative price returns, again, gets a lot higher when you look at a short time frame, meaning that we have 300 observations when the S&P was negative if you just look at, say, a few days' time. Now, that intuitively makes sense. When you span that out to a longer time frame over, again, how many periods of observations we have where it's 5 years and the S&P was negative, only about 120 observations between 1950 and 2023, not too bad. But again, it's this idea of, can you stomach a deeper drawdown over a shorter time frame when you are that retiree who needs to begin to take, say, a decumulation phase in your portfolio? And that's where the buffer fits in, Rick, because that's the bread and butter of why we want to talk about buffer ETFs in retirement, is to, again, mitigate that drawdown, protect on the downside, and have less of that hole to dig out of, and avoid some of that really kind of compounding risk that can occur.
So we're already getting a ton of questions. People are fascinated based on their questions, I'm seeing, by what you're describing. Kevin's looking for a little bit of clarity. He's assuming, and I'm assuming he's right, that the way you're executing this strategy is by buying equities or a basket of equities, or you're buying the S&P 500 and you're layering it with an option strategy, correct?
Actually, no, and that's a valid method. So Innovator has chosen, though, at this point, to keep things extremely simplistic. Our goal is to only have kind of 4 positions in a standard portfolio. Instead of buying the equity basket, what we do is we buy a deep in the money call, and that is going to be your, again, synthetic exposure to the S&P. So you get exposure by that deep in the money call. That's going to give you the one-to-one upside downside that you're mimicking the S&P. And then from that, Kevin's question is accurate, that you then have a sold put option and a bought put option, and then a sold call option. I don't want to, again, confuse folks too further. We could talk about it at length, but the bottom line is we're doing all options-based portfolio.
So yeah, you're doing this synthetically. You don't need to buy the basket of
No.
the S&P. You're able to do it exclusively in the futures and options market.
Yes, it makes our trading extremely efficient. It makes our products very liquid. It makes them very flexible. It's quite actually elegant in how we do it.
And that's raising 2 other questions, and you know these are coming. First, what are the fees associated with the funds?
So they range in fee. The Power Buffer series I've referenced a lot, that 15%, we call it the Power Buffer, is about 79 basis points. That's going to be the high end for us. It's going to be 89 basis points for our emerging market exposures if you were to go that route, and down to that 69 basis point for the quarterly series. So there's kind of this range between 89 and 69 basis points. That's right in line with the industry average. In fact, slightly lower than some of our peers in the defined outcome or buffer space.
And the second part of the fee conversation are taxes. Talk about the tax implication, or how tax efficient the strategy is.
Yeah, there's 2 ways to approach that topic. At a high level, I'll just say they're very tax efficient and tax advantageous in a portfolio, because at a high level, they do not issue distributions. So for clients, we talk about this from a retirement standpoint, or from a defensive standpoint. We've not built these to be income plays, intentionally so. When you have an income coming off the ETF, you're oftentimes taxed at ordinary income rates. It could be a high tax bracket of now 40.8%. So to avoid that and control your tax destiny, as I say, is actually very advantageous. And so if you hold a buffer ETF, the only tax consequence you face is upon sale of the ETF, just like you have an equity ETF. If you bought it at $5 and sell it at 10, you pay gains in the $5 gain, but again, you control that timing. And so to be able to have a possible long-term capital gain holding more than a year is very advantageous. If the question was about taxes inside the portfolio, the creation redemption mechanism holds as other ETFs have, and we have the same benefit. It's been very tax efficient, no capital gains, and again, very advantageous to the end consumer.
So that raises a really important point regarding the implication or adoption, inclusion of this strategy into a traditional 60/40 portfolio. Retirees are always trying to balance their need for current income against their need to both preserve income and protect it against inflation. Because if you didn't have to worry about inflation, you would just throw the whole thing into bank, CDs, call it a day. But we know net of inflation, net of taxes, CDs are a loser. So we've got to earn better than the inflation rate. And that means putting it into equities or getting equity exposure. The problem with equities is that it doesn't generate the income that they need, which puts us back to square one. So this is why retirees and their advisors create typically 60/40 portfolios or something along those lines, a balance between stocks for growth, bonds for income, to try to give you the best of both worlds. How do you see advisors and investors using these buffer ETFs in the context of that 60/40 portfolio?
It's a great question. And it's probably the most common question we get from people in this stage of their life cycle. Again, we are not using these as an income replacement. So that needs to be acknowledged. And we want to say, to clients that need the income, we understand that. If we're using it from that risk mitigation standpoint and trying to balance the portfolio between those two objectives, you really see the most benefit kick in when you utilize almost a 20% sleeve towards buffers, pulling that from fixed income. So calling it, say, instead of a 60/40, using broad terms, looking at 40 as the ag, instead of 60/40, maybe we say 60/20/20. And there you'll see actually outperformance over the long term. You'll see better drawdowns in the downside. Again, the income is reduced slightly, but if the client's goal is capital preservation, we feel it's a fantastic way to then link your conservative dollars to the equity market. Because again, to Rick's comment, you want to avoid the boogeyman of inflation and have a higher upside potential. There's a way to do that with buffers, linking these to the equity market.
So I have to admit, Andrew, that that's not intuitive to me. I get what you're saying, makes perfect sense, but I thought you were going to say not 60/40/20 or 60/20/20. I thought you were going to say 40/40/20, on the attitude that since you're creating synthetic equity exposure with downside protection of those equities, you would draw the allocation from the equity side of the house so that your income is unchanged coming from the bond side of the house. But no?
And you could do that. Again, it's I don't want to talk about both sides of my mouth. It's client objective. So if their primary objective is the income, we hear that. I agree with you. If you're looking from, say, a risk adjusted basis while still maintaining some income, which has been a conversation we've been having, the numbers we look at show that 60/20/20 has actually been quite beneficial. But you're right. Okay. Either side works. We want to give you, though, that still growth potential in an era of higher inflation that we've seen.
And clearly you gave the best answer. It's client specific, depending on what your needs are, your risk tolerance, how much income are you looking for, life expectancy, all those kinds of good things. So you're going to choose, I would say, one of those two or within those ranges. It's either going to be a 60/20/20 or a 40/40/20 or somewhere thereabouts, depending on your circumstance. That makes a whole lot of sense.
I would say, not to interrupt you, sorry, Rick, is we have seen, and this is not just because I work at Innovator ETFs, it really does require almost that kind of 15 to 20% range of buffer exposure to begin to feel the full effect. It will not harm you to put money into buffers. And in fact, it gives you that sleep at night quality. But to really affect the portfolio, it does need to be somewhat substantial to see the full effect kind of trickle down across a broad high net worth portfolio. So that's why we say that 60/20/20 is not just to go for the highest dollar amount, because that's where the most bang for your buck comes from.
And I just want to reiterate this for you because we're getting a couple of questions in this area. Mark has asked, for example, are monthly distributions allowed? And you said these are liquid. These are ETFs you can sell whenever you want. So it's not a question of monthly distributions. It's a question of daily sales, if that's what you choose to do. But that kind of defeats the purpose of the strategy if you were to do that.
Correct.
So
we have seen folks ladder into these buffers. That's also an option, is to say you buy multiple of the series, and then as you have a need for income or for distribution, you could then sell out of the buffer of your choosing.
Well, then elaborate on that for me from a laddering. You mentioned different time frames that these ETFs have as a target for the contracts you're buying. So give me the range. What's the shortest? What's the longest?
Yep. So we have a 3-month outcome ETF. So it's a quarterly ETF. Again, you just buy it and hold it, but each quarter we're resetting the parameters under the hood for you. And we also have up to a 2-year outcome period. We have, again, a higher cap because you're able to go out those 2 years. But again, your outcome period, your buffer is realized over those 2 years. So it runs 3 months, 6 months, 12 months, 1 year, even 2 year is our outcome period.
And I'm assuming that the investor, again, true or false, the investor ought to pick the term, 3 months versus 2 years or in between, that most closely aligns with their expectation of needing the capital back. Is that about right?
Yeah, that's a good way to think about it. And then one more wrinkle in here is that we also have clients that still like their annual outlooks and how they think through with their FA or with their end client, how they think through their planning, but they know they're going to have some need along the way. And so they might say, buy the January series for the annual outcome and also buy the February series for the annual outcome and almost build their own ladder that way. And so again, it's always this annual period, and yet they're kind of getting a monthly roll, if you will, that they're able to say have withdrawals as they need as well.
Which
Flexibility there.
which means that since you go out 2 years, that you have 21 of these, the shortest
Yeah,
at 3 months and all the way out to 20 to
there's a lot
24
of
months.
offerings, yeah. And then we have them on flavors like the emerging markets, international, NASDAQ 100, Russell 2000. So there's a lot of our tickers, and you can quickly see how it becomes a large lineup.
So you can pick whether you want to track to, whether it's emerging markets or the large cap stocks or the small
Yep.
cap stocks or the tech stocks. So whatever you want to do, you can do with all these. So that's a
Yep.
lot of tickers. That's a lot of different ETFs you've got.
It is. And my goal and my role and conversations like this today are just so helpful because it's a lot of tickers on paper. And yet it breaks down quickly into about 5 or 6 kind of suites of products, right? And it really is about customization and what's best for the client because you pick your outcome period, you pick your exposure that you want to get at exposure to, whether that's the NASDAQ 100 or the SPY, and you pick again your downside protection that you need. And so that's because that multiplication effect does allow for a lot of tickers, but really the principle is quite standard across all these different flavors.
Got it. People, the questions I'm just looking at here that people are asking, I'll put in the category of I'm trying to get my head around this. I said at the very top of this conversation, this is a new and different, innovative idea, hence the name of your company, Innovator ETFs. So people are just trying to get their head around it. So I want to ask you a couple of questions that kind of go together, one from Bryce, one from Lauren. And you kind of made an allusion to this early on, that the founders of your company who came from Invesco, one of the biggest asset management firms, looked at the problem in the marketplace that, this was an invention created to solve a problem. And the problem was that income-oriented retirees typically turn to either annuities or structured notes because of the predictability that those products provide, the stability and expectation of how much income I'm going to get. But those products often come with cumbersomeness or high expense or limitations or tax implications, et cetera. So the questions that an anonymous individual as well as Bryce and Lauren are asking is, how do these differ? If you could elaborate on, why don't I just go buy an annuity? Why don't I just go buy a structured note? How do these differ?
Yeah, they differ, and it's a great question. This is a fantastic question. They differ in the sense that it is the ETF wrapper doing the heavy lifting to give you the advantage. And so for those outside the industry or those kind of new to ETFs, that might sound foreign. What do you mean? But in reality, that vehicle, the exchange traded fund, that as it's designed, offers a lot of inherent benefits compared to say annuities or structured notes or fixed index annuities and the rest. And that's not to say that every product like those are not to be utilized. In fact, they can be a bit more customized, et cetera. So we see a place for everything here. But for the ETF vehicle, you get intra-period liquidity. There's no lockups. You don't have a surrender charge. It's lower cost than an annuity. There's no bank credit risk. If you had a bank note, there's no phantom income so there's all these kind of characteristics that, again, it might be appropriate to have you in that annuity if it's customized to you personally. And yet the ETF wrapper provides these transparency, liquidity, tax efficiency, lower cost, all these things that come with that wrapper is where you see the benefit. Because these strategies that we're taking, these defined outcome strategies, are not new to the marketplace. The new innovation is putting them inside the ETF and making it, again, a more accessible product to the masses and more easy to implement into portfolios across stocks and bonds. But it's a great question to ask.
It would seem to me fees is a big conversation. Annuities are notorious, and structure notes too, not only for high fees, but lack of transparency in their
Yep.
fees.
Yep.
But you said your fees, the top is 78 basis points, did you say?
It'd be 89 for the emerging market exposure, but what we're talking about today is mostly in that 79 range.
Which is, that's not out of the ballpark for emerging market ETFs or a whole slate. So it's well under 1%, and that's it, all in. There's no hidden
Correct.
fees, no surrender fees, no other fees.
Correct. Yep. And
Um,
then and that's the beauty of the ETF.
Chris and Brandon both are taking me to task for a comment I made regarding the market's long-term average of 10% a year. As Brandon points out, rightly so, the market never actually earns 10% a year, even though that's its average. It's always higher or lower. And Chris points out that dividends represent a very significant part of the stock market's historic return. It isn't appreciation, but rather the dividends. So talk about the market averages and how that impacts why somebody would want or not want this strategy, and the dividends as a part of the overall return, and how the contracts you're buying play into all that.
Again, that's a very nuanced and intelligent question to ask. Our ETFs do not issue distributions, and we track the S&P price return index, because when you buy the options only portfolio, you do not receive a dividend. So that's where the question's coming from. And yet, when I was quoting the stats that I had earlier of calling about 75% of kind of market outcomes we are able to encapsulate, that is looking at the S&P's total return figure. So that's the same. Let's say the S&P total return is 10%. Maybe our cap is 9. There's going to be a slight difference in that. And yet, over the longer term, we're able to encapsulate about 75% of all experiences with that 15% buffer. So yes, to the question, our ETFs do not have the dividend embedded in them. You don't receive distributions, but we are tracking the S&P price return. However, over the long term, the goal of, again, giving you mass exposure to the S&P's upside is there. And since 1950, I think, Rick, the number I pulled before this was like almost 11% annualized return. And that's total return. We agree that's total return. But even with the buffer ETF, your cap is based on the S&P price return. However, it's embedded in there for the options pricing, where it's pretty similar over the grand scheme.
Right. And so your explanation of the structured note and the comparison to it, as well as the annuity, Edward is asking, isn't this the kind of product I used to criticize? No, I used to criticize annuities and structured notes. This strips away a lot of those objections I always used to raise, which is why this is such an innovative product and really, I think, rather fascinating. You haven't yet addressed the issue, Andrew, of why an investor needs to care about market volatility, since in the long run, it doesn't really matter whether, because markets are going to go up or down, but in the long run, you're going to be fine.
Yeah.
And yet income-oriented investors really don't have that luxury. You haven't really addressed that yet.
Yeah, and that leads to, again, I sent you 2 other slides here, Rick. This is what we kind of call for the retiree portion. It's not our term. It's obviously an industry term, that sequence of returns risk, meaning that it matters your path to where you end up. And so as these slides come up, what I was seeking to show with with this first slide here is, I think, fairly straightforward. It's taking actually real live data for you see the top bar. It's 2 different return streams that end at the exact same point, but you can visually see they got there very differently. And so the top line, the A, darker green, is 1950 to 1970. And the B line, the light blue, is, call it 74 to 94. They both end in that same point. It's actually very convenient. Yet the path there was very different. So if you're to take that and extrapolate that into kind of a hypothetical scenario, and Rick, go to that next slide, please. What you see is that your timing matters on when the drawdowns occur, and you need to actually avoid these drawdowns. So what you see here is taking the same 2 return streams, the same 2 return patterns, and applying it to a hypothetical portfolio with $2 million in it. And what you see is the top bar, the dark green, turns out fine. We're assuming, again, in the fine print there, you'll see withdrawals of $150,000 that increase to account for inflation. So it's a classic retirement portfolio that you are going to have some decumulation occurring throughout it. Well, the top green bar does just fine. Even with that 150K monthly coming out, it's still going to appreciate in value. It still ends positively and has actually gained $1 million over that 20-year time frame, even with the decumulation occurring. Well, that bottom blue line that we just saw previously end at the exact same point, the minute you introduce this decumulation aspect of withdrawing your $150,000 annually, combined with that initial drawdown you see on your chart with that 34% drawdown, the yellow dot there, once that happens and then you begin to withdraw, it's almost like you're eroding your capital over time. And that
In
light
other
blue
words,
line, you run out of money.
people who retired, who had the unfortunate bad luck to retire in 2021 in the depths of the pandemic, are setting themselves up for a much worse scenario than people who are retiring in 2022 or 2023 or 2024 when the markets were doing so much better. Just
Absolutely.
the bad luck of the draw.
Absolutely. And our comeback to this is the obvious one from today's conversation is to say your goal should be to, again, avoid these steep drawdowns as best you're able. And what better way to do that than to incorporate an equity linked buffer? Because then you have this known downside protection that's going to get you most of it protected with, again, the known upside of the market linked participation. So there's a lot that you can like about incorporating a buffer to avoid this sort of scenario where, hey, you have these planned decumulation events occurring, and yet I'm going to erode my capital time if I do it if I get unlucky and have it at the wrong time.
And this is the piece that, frankly, many financial advisors miss, and certainly the vast majority of investors. And it's because of two things. One is the bias of the financial services industry, and the second is because of the coincidental performance of the financial markets over the past 30 years. Most advisors are over the age of 60 today. The average advisor in this country is 62. And I'm 66, and we've been doing this for 30, 40 years in this business. And most of us began our careers in the 1980s or 1990s. And we have experienced, ever since we all know the economic situation in our nation's history, from 1982, we have enjoyed a big bull market. There have been occasions where things went bad, 1987, 2001, 2009, the pandemic most recently. But generally speaking, for the past 30 plus years, life's been good in the financial markets, and we've seen incredible wealth created, which means people have generally had a bias embedded in them of upside. Markets rise in value. Second, the financial services industry makes its money managing assets. And not only asset managers like Innovator and every other ETF provider and money management firm, but also investment advisors themselves. We make money by managing assets on behalf of our clients. The fees that we earn are based on the assets in the account. So there's a huge focus in our industry, as well as among investors themselves, for asset accumulation, getting money into the account. We're really skilled and experienced and focused on adding money to the account. Every advisor in the country can tell you what the IRA maximum contribution is, what the maximum 401k contribution is, the maximum 529 college plan contribution is. We know how much you're allowed to add to your accounts. But when it comes to withdrawing from those accounts in retirement, number one, most investors don't care because they're not yet retired. And second, there's not a lot of economic incentive for Wall Street to help clients withdraw money, because that just reduces the money under management, which reduces the fee the advisor is collecting. And so there's an emphasis on adding money to the account and not withdrawing the money from the account. Asset accumulation as opposed to asset decumulation. And because of that, most advisors and certainly most investors are unfamiliar with the chart that we're looking at right here. They don't, because when you're coming to invest, it really doesn't matter when you invest. The best time to invest is always yesterday, and you should invest as early and as often as you possibly can, kind of like voting. But decumulation matters a whole lot, Andrew, as you're showing on this page. When you withdraw matters incredibly to the ultimate outcome of how long your money is going to last, right?
Absolutely. And I mean, that, Rick, what you said is all accurate. I wholeheartedly agree. It also comes in that same vein of you want to avoid the worst rather than avoid the best, if you will. So some people are saying, hey, I just want to play it safe all the time. The goal should be actually just avoid the worst. If you're able to, again, remove the 10 worst months out of the S&P, your annualized increase your annualized S&P return would increase by over 2% just by taking away the worst 10 months from 1950 to 2023. So you take out that almost 80 odd year span, you take out the worst 10 months, your annualized return goes up 2%. So there's an idea where, to your point, both decumulation, but also just that protection element is so powerful when you think about a long-term client portfolio in over that whole kind of CFP type planning process.
And let me elaborate on that, because the notion of just avoid the worst months smacks of market timing. And of course, nobody's any good at market timing. But you're basically saying you don't have to worry about it with the buffer ETFs, because all we're saying is there will be a big decline. We don't know when. We're simply saying we'll protect you against it when it occurs. And we don't have to try to time the market and guess when it'll occur, because that's a fool's game.
Correct. I mean, again, I have a wealth of stats. I don't want to just keep throwing stats out the entire time, but one thing I will say is that, to that point about total return versus dividend return and the rest, it's a good question. And yet, at a high level, when the S&P total return wise is negative, so when it's negative, its annual negative return is 11.6% since 1950 to 2023. So again, when it's negative on an annual basis, the average loss is just north of 11%. Well, a 15% buffer would encapsulate all of that. Now, if you apply the 15% buffer, because of the way the averages work out, and you have a few years beyond that, your average loss goes from being that 11% on average to only about 2% on average when the S&P is negative. So you don't always buffer all of it. There's years when it's down more than 15%. We acknowledge that. But just again, that intuitiveness of, wow, I usually if the S&P is down over the year, I'm going to lose 11%. Well, I put on this buffer. If the S&P is down over the year, I'm losing 2%. It's pretty powerful on average. You think about that from, again, the client lens of desiring stability and having that kind of that loss aversion. We all know from behavioral finance, loss aversion is it hurts 2 times more to lose than it does to win. We're helping the client conversations in that realm as well.
So further questions, we're getting some folks. You had mentioned that you offer links to emerging markets, large cap, small cap, et cetera. Any plans to create a product that links to crypto?
Well, my compliance department sitting nearby me today, I'd be careful what I say. I can just acknowledge that we have filed. So I'll just mention that we have filed for a crypto-linked buffer ETF. You can find it by Googling it yourself. I will not speak further on that topic, but just know that we are certainly aware of industry demand and have made steps towards that direction.
So we had several questions on crypto, all on that. So you've answered all those.
I'm glad to see those too, Rick. It makes me feel like we're in the right direction with our filing, but look it up for yourselves and you can tell me what you think.
Yes, indeed. And a couple of other related questions regarding age and longevity. Does this product, does this strategy help to reduce longevity risk, the concern that people might outlive their money?
It really does. And that actually is very similar to that previous slide. If you look, and it's hard to see on our Zoom screens, that bottom portfolio that had that decumulation occurrence, it ran out of money in year 16. And so we talk to clients, if you say have a 20-year retirement plan, a 30-year retirement plan, of course, longevity, as Rick mentioned from the outset, we're all living longer these days, which is a good thing. It means our retirement portfolios need to be designed for that longer term. Absolutely, the buffer ETF is a way to, again, extend the longevity of the portfolio and avoid those kind of intra-period declines you just cannot stomach. So we're not trying to hit home runs on the upside, but we feel that when a client gets to that stage of their career, that stage of their life cycle, the portfolio, again, their objective is preservation. It's not to say hit a home run and have another 100% gain on, say, crypto in the next year. It's that balancing act they're trying to walk.
There are 2 big macro questions that has everybody's attention these days. I'd like you, Andrew, to address both of them if you can. I'm not sure how relevant, but I want to make sure you get the chance to discuss them. First, AI. Any implication of AI on this strategy, on investing generally? What are your thoughts there?
It's a good question. It doesn't apply directly to us. And here's what I mean by that. You've seen a couple of AI ETFs come out where, say, the index is AI based, or it's doing stock picking for you, if you will, with the human oversight. We see all that, and yet that's not our game. Our game is to add the buffer, add the protection onto existing reference assets, as we call it. A reference asset, again, being the S&P or the NASDAQ 100 or Russell 2000. So in the future, at some point, let's say an AI-based portfolio becomes very large, maybe we say put a buffer around that sort of idea, but that's not on the horizon right now. We're not doing stock picking, of course. And so that AI element of selection has not come into our world at all. I do think the question of AI for things like the overall financial markets is fascinating. And in that sense, we have seen folks move more towards, say, the QQQ buffers because they
Mhm.
have this, kind of this latent desire to get exposure to the AI boom, things like NVIDIA. Well, in that case, maybe there is a higher upside, and let's put, say, our equity dollars in a conservative fashion towards the Qs. That's probably where you see it most affect our portfolio. And that's not a bad point because, again, QQQ is the largest creator of wealth the world has ever seen, and yet it's highly volatile. And so if you can say get the Q's exposure with guardrails in place, it's a pretty compelling story. People like it a lot. Again, the caps are inherently higher on the QQQ products than the S&P products because of the higher volatility nature of the product. But again, you have this element where AI is going to be more the second order effect for us at this point, not so much the first order effect.
Got it. And the second big question everybody's focusing on, of course, is the election. The Trump administration, Republican-controlled Congress coming in January 20. You anticipating any implication noteworthy there for you?
Well, it's a good question. We don't have any explicit call, and here's why. We know it's a bit of a fool's errand to make prognostications for the next 12 months. What you do see, though, is that one, there's been no trend historically between a Democratic president or Republican president over the intermediate to longer term. And two is that you have maybe a rotation towards small caps occurring. So while I just got done saying we're not going to prognosticate on the exact movement and call it a price target per se, what you do see seems to be a groundswell is towards the idea of small caps. And so just like I mentioned, having maybe the NASDAQ 100 be your AI play, maybe you have this, again, somewhat viewed towards, hey, it feels like we're going to have decreased regulation. We have Doge beginning. We have decreased regulation. We have efficiency beginning. We have unlocking of growth occurring. Let's look at small caps in 2025. Well, if that's the case, again, we have an entire small cap suite. We can say get access to small caps and still maintain some guardrails if the trend does not continue. And so maybe that's the area I'd point you towards is say we have a couple of investment outlooks published, which you could find on our website. But at a high level, small caps is an area of interest for us as we look into the beginnings of the Trump presidency.
And speaking of your website, I believe we have additional slides. In addition to the slides that we have just shown you, we have a deck that Andrew has put together that we're going to post to you right now. So you can find that being pushed out with a lot of great information, including the slides you've already seen. And that also has the website for Innovator, so that you can go to their site, get a whole lot of other tools, information about everything that they're doing, because we have several folks asking for your website info. It's all in that document that we just pushed to you. So go to the bottom of your Zoom and you'll find it there. Related questions for Michael. Do you have any plans to offer any of these buffer ETFs that offer a yield?
We actually have a series of income ETFs right now. We won't talk about them today. We have done that. Look, I'll be frank with folks. They have not seen as much investor interest as we expected. They're certainly, they work, they're out there. I think folks view these more as, again, a growth type instrument they can get a little protection on, but the income buffers do exist. We have a few of them ourselves. So they are out there. Check them
You
out
had
on the
mentioned,
website. So go from there.
yeah, so yeah, just go to the website, you'll find all that info there. So you would mention the fee, but not the investment minimum. And G is asking that question.
The beauty of the ETF is there is no investment minimum. All you need is enough money to purchase one share. And then if your broker dealer does fractional shares, possibly less than that. So again, most of our ETFs trade around the $25 mark. Some will be higher than that, of course, the market appreciation. Maybe it's $40 a share, $50 a share, what have you. But when they launch, they're at that 25 figure. So again, if you have money for one share, you can buy the ETF. You can buy it through your brokerage or through your financial advisor, best access point.
So they say that imitation is the greatest form of flattery. And somebody's asking here, has any competitor, any other ETF company tried to replicate what it is you're doing?
Certainly. And as my bio stated, I've been doing this for almost 15 years. I'm not naive at this point. Finally, I've gotten over that stage, I think, to my naivety. And we have a number of competitors in the space. But the beauty of Innovator is that we were first to market. And there's something to be said for that. When we talk to clients about the value that we bring to the table, it really is our sole function as a firm. You can look up our holdings, look up our ETFs. You'll see that's all we do day in and day out. And that's not to knock the other firms doing this in the moment, but it's not their sole focus. And you'll sense that. You'll sense that from a focus standpoint, from a sales standpoint, from a support standpoint. It really does come through in an expertise standpoint. So with ourselves being the pioneer that really brought the first ETF to market in the space, The others following. We have had a number of competitors come to market, but again, we've maintained our leadership by number of products and continue to push forward.
And I have to assume that since you're tracking indexes, this is benefiting competitors as well. You mentioned QQQ, for example. So
Yeah.
Invesco has to be happy that your QQQ product is popular because that has
Yep.
to help them.
Yeah, absolutely. There's always a trickle down effect behind the hood or under the hood, excuse me. And you do see, again, an incremental kind of adoption towards the Qs when you have something like the QQQ buffer ETF being utilized. It absolutely is a true statement.
So what is the common questions that you're getting from advisors and investors? Because this is, I think, a new and different approach than most are familiar with. So what are you hearing in the marketplace?
The common question right now is really around our 100% buffer ETFs. We have clients say, well, I haven't heard of this before. How does this work? And so I'm not trying to dodge your question, Rick, with a high level, but really right now it is about 100% buffer ETF. So these ETFs are as simple as they sound. Because of the current market environment, interest rate levels, et cetera, we are able to offer 100% downside protection. You will not lose money over the outcome period. Again, we talked about the interest, and you get a upside to a cap. Now, right now, our recently released December 100% buffer offering is giving you a cap of 7.78%. So people are asking, well, the question is, well, what's the catch? The catch is that the market has to go up, and it's linked to the S&P. So whereas somebody holding cash, let's say the market really does decline, say 10, 15%, you're still getting your cash yield monthly as you have it. That 4% comes in, whatever it is right now. We acknowledge that. And yet for the client portfolio, the retirement portfolio that needs a little bit more growth or a little bit higher a return to track with inflation, these 100% buffer ETFs have been very popular because again, there is no downside risk. It's just that the upside is linked to the S&P. And so again, if you think the S&P is going to return 5, 6, 7% next year, that's better than cash. You want to go towards this 100% buffer ETF. Just keep that protection on the table and get some upside. And that's been a very, very common question we've had recently.
If you hold it till the term, you're going to be insulated against loss. What if you sell it during the term?
Exactly upon your position of entry and exit, meaning that if you bought it at, again, all these have a net asset value like any other ETF. So you bought it at, say, $25 a share. Let's say the market's actually gone up, and so has the ETF to $26 a share. When you sell it, you will have a taxable gain on $1. So your experience of that defined outcome, as we call it, is really over the set period. So again, that 100% protection is from December 1st of this year to December 1st of 2025. And if you hold the ETF over that course of that time and the market's down 50%, you're down zero. And then on that next date in 2025, the ETF will reset under the hood, no action needed on your part. Your protection resets to the fresh 100%, and you have to the races for the next 12 months with a new cap that's going to solve for the cost of that protection. And so it really is a very, I think, a real benefit to clients that have less need for income, but still need for preservation in a portfolio.
You know, it's really a fascinating concept as you describe it. I mean, there's a lot of folks who routinely, or financial advisors recommend this all the time, having cash reserves, an emergency fund,
Yeah.
money that you're frankly hoping you're never going to spend. It's just there in case. And folks are routinely stashing that cash in a low interest yielding bank account. Why not? Why not? I mean, the risk is you lose the 2 or 3% that you might have earned in the bank. But
and I was just saying, and I get excited talking about it. You can see me interrupting you, but I would say that the other benefit here that's a little unspoken is going back to that tax question. Yeah, you get that 2 or 3%, or maybe even 4% on cash, but that's pre-tax. So
right.
that cash is taxed at ordinary income rate. So if you're a high earner, that tax is taking you from about 4% to 2.5% after that 40% tax. So is it really like you're really getting 2.5%? Whereas the buffer ETF, if you're linked to the markets, can get you that 7 to 8% if the S&P goes up. And there is, I'm using air quotes here, no taxable event until you sell. So
And when you do, it's a capital gain event, not an ordinary income event.
And so you're taxed at a max rate of 23.8%. And so there's an element where you have a massive kind of tax alpha, if you will, where you really begin to see the outperformance compound when you say hold the buffer ETF for a longer period of time.
So related to this, talk about the notion of using this inside an IRA.
Yeah, again, that benefit that I just described does decrease slightly inside of a qualified account. But
But
we
do you
would
find
say
a lot of people using IRAs for their
we still
investment here?
do. We still do. And it's because, again, this people have missed out in this bull run for the last, call it, 20 years almost, but especially in the last 2 or 3, they felt like, hey, 2022 was so negative. I want to get out of the market. Well, all of a sudden, 23 and 24 have absolutely ripped. And so the idea is now they're kind of doing the investor psychology of getting back into the market. Well, the way to do that is with some guardrails in place, with some uncertainty still out there. And so we've absolutely seen, regardless of qualified or non-qualified, we've seen use for these buffer ETFs because it's a way to get your assets linked to the equity market, get that upside. We still think that there's room to run, but who knows? And let's put some guardrails in place as we do so.
This has been a fascinating conversation, and I think really demonstrates well the need to look at new and different ideas compared to what traditionally people may have turned to for their long-term planning. And I think that there's a role for serious consideration of Innovator ETFs inside a diversified portfolio. Andrew, this has been really terrific information. I think that folks are going to be sending a lot of inquiries your way. The link to the docs is on in your Zoom, giving you Innovator's website. Recite it off for us just real quickly.
Yep, it's just www.innovatoretfs.com. So all one word, innovatoretfs.com. There's about 10 different tools on the website to help you diversify your exposures and to figure out what you want to look at. And then each product page has its own specific outcome periods with, again, a wealth of information there for you to look at.
Andrew, thank you. That was really terrific. I want to tell you that January 15th, we have an event coming up to answer all your crypto questions. Most of our webinars on the subject have frankly, an agenda, an outline of what it is we want to talk about. But in this particular event, we're going to simply focus on what is on your mind. There's so much attention focused on the subject of crypto these days for all the obvious reasons. And I know you've got a lot of questions. So we're going to invite you to feed your questions to us so that we can tackle all of them in an event. Zach Pandel, who's the head of research at Grayscale, the largest crypto ETF provider in the country, will be joining me. That is January 15th. The event is free, and you can register by going to dacfp.com, dacfp.com, and sign up for that. And I look forward to seeing you there. Andrew, thank you so much. I wish you and your family and everybody watching a very happy holiday season and a wonderful new year. Andrew, thank you so much for joining us on today's event.
Thank you, Rick. I appreciate the time.